Welcome back, everyone, to this lesson on the covered call options trading strategy. The objective is to receive guaranteed passive income on an already existing position. So that's a pretty good position to be in. If you already have a security that you own, whether it's a stock or an ETF or another security where options are being offered, it's a great way to receive extra income as you're holding that position. If you're holding the position anyway, it's another way to receive extra income. Now, what are the pros? Is there a risk of losing money since you plan on holding anyway? If you have a stock that you have, for example, and you don't want to sell it, you want to hold it in the long run, and you're already willing to assume the downside risk, then as you're doing that, by doing a covered call strategy on this stock, there's zero risk of losing money. So that's the first pro. Number two, it's a one-leg strategy. So it's just one option. There's no other options together with it. That means that it's a less commission intensive trade. It's just one leg strategy. Okay, what are the cons? The cons are if the price of the stock eclipses the strike price after expiration, you lose the shares at that price. So you're going to lose that movement anywhere above that strike price. So the premium you receive may not compensate for that move above that strike price. So you would have to consider that as kind of like money that you could have made. It's not an actual loss, but it's money you could have made if you didn't do the covered call. Okay, so I'm going to use this strictly as an example. This is Coca-Cola. Coca-Cola, over the long run, has gone up in price, and at the same time, it's paid dividends. So it's been a very good investment over a long period of time. And let's take a look at that performance. Go to the weekly chart right here and change the time frame to 20 years. Now, as you can see, in the long run, this company has gone up over time. As you can see, it's paid a lot of dividends. So it's been a good company to hold. It's a great business, and you're willing to assume the risk of this company going down when you buy it because it's a very good business. Okay, so let's say you want to get some extra income. So let's say you're trying to get some extra money from the return. Now, keep in mind, it's already paying a dividend, and by doing covered calls on this stock, you can actually receive some extra money. So I'm going to show you how to do that. I'm going to be using the Thinkorswim platform to enter this trade. This is the charting that they have right here. So I'm going to be going to trade. And right over here, you can see an options chain. Now, each option has an expiration date. There's one coming up here in 4 days, 11 days, 18. So these are weekly options. Generally, large liquid stocks generally have options that expire every week. And that's the strategy I'm going to implement. Now, you can choose options that are further out to expiration. You will receive more premium, obviously, because they have more time remaining on them. However, a good strategy would also be to consider weeklies, because every week you can continue to sell an option. And by doing this, you can also avoid certain times where you might not want to do the covered call, and that would be during earnings. So when earnings come out, stock can really experience a lot of volatility. And when that happens, it could go really high in a short period of time. It can go right through your strike price. And as a result of that, you can get your shares, what they call called away. So you lose the shares at that price, and you can always buy them back, but you might have to buy them back at a higher price, which you might not want to do. So we want to look for a period of lower possibility of earnings causing you to lose your shares at a high price. So as you can see, there is no earnings coming up. So we could do one covered call that expires in 11 days, because 4 days is just too short. There's going to be very little premium to make on that. So let's go for 11 days, and that option expires December 15th. So go to the call section, which is right here. Here are calls, here are puts. I'm going to go to the call section. What I'm going to be doing is I'm going to be choosing a strike price, which is out of the money. So it's going to be above the stock price. The stock price is trading now at 58.57. So what's the next strike price above 58.57? That's going to be 60 right here. So right click, go to buy, and then go to covered stock. Okay, I'm going to change this to 1. So I'm only going to be doing one option. Okay, so this is the trade that we're going to be entering. we're going to be entering a trade where we're going to be buying the shares and at the same time selling a call against those shares. So we're buying 100 shares of Coca-Cola, and that's going to be at the market price. Okay, so in this case, it's 58.57. And at the same time, we're going to be selling one call that expires December 15th at a 60 strike price. Okay. The good news is this is automatically potentially a profitable trade, even if this stock goes above 60 at expiration, and then the shares get called away because the sold call now gets exercised. So you have the stock to give away to the person who purchased the call because his option is going to be exercised. So basically what happens is you will lose the shares at a higher price. So you're already making money on this trade if that scenario happens, because you're going to be buying the stock at 58.57, and then you're going to lose the shares at 60, which means you're going to be selling it at 60. So already you're going to be profiting if that happens already. So already you're looking at a profitable position where there's no risk of losing money. This call is actually already making money for you, potentially. The only risk, of course, like I mentioned, which you're willing to take anyway, because you want to own Coca-Cola, right? You want to own it in the long run. You're willing to take the downside risk anyway. And of course, you got the dividend that's paying out. So for you, it's a win situation because of the fact you want to hold the shares anyway. So what you would do now is you would go to confirm and send. Now, right here, it shows you what's happening with this trade. Okay. Right here, you see the maximum profit, $153. So right here, you can see in 11 days, you're going to make $153. That's your max profit. So the profit is maximized. You can't make any more money than this. You actually have the $153 right now. You make this money immediately. This $153 goes into your account. And at the same time, of course, you own the shares. So as you can see, the max loss is 58.47 because that's the market price right now. See the market price says 58.47. So if this stock goes to zero, that's the most you could lose. Like I mentioned before, you're willing to assume the risk by buying these shares anyway. So that's how the trade works. Now, before I enter it, right click, go to Analyze Trade. So as you can see here, the zero line is right here. See, as it goes further and further and further down, you're losing money in value of the actual stock. And as you can see right here, anything above zero is right here. Your profit is maximized. You see, if you look at this box over here, you can see that your max profit is $153. So this gives you a visual of what this trade is doing when you enter it. Okay, let's go back to trade. The reason why it says 58.47, this is after hours trading. You see here it says 58.57. The last price is 58.47. Okay, go to confirm and send. Send. Okay. Now it's after hours, so it's going to show that it's working. And this should get filled when the market is open. Now, how do you manage this trade? Where do you go from here? So there's really not much to really do here. There's two things that can happen. Okay. Your strike price that you entered is $60. The price right now is at 58.57, right? If by December 15th, which is 11 days from now, the price is below 60, you keep the $153 and you still maintain the shares. The shares are still yours. If the price goes above $60 by expiration, all right, so after December 11th, it is above $60. What happens is you keep the $153 and you lose the shares at $60. So like I explained, you're going to get another profit because you bought the shares at 58.57 and your strike price was at 60. You lose the shares at 60, meaning that you sold them and you originally bought them when we did the covered call entry at 58.57. Now, what can also happen is the stock price goes down. Let's say it goes down to 58, 57. In that case, you're going to keep the $153 and you're still going to maintain the shares. So as you can see, there's no risk here with this call option. Now, the only risk, if you want to call it a risk, is any potential gain. Let's say the stock really jumps. It goes to like 61 or 65 or higher. In this short period of time, all those potential gains are gone because you're going to lose the shares at 60. So anything above 60, if it goes to 61, 62, 63, you're not going to benefit those gains because you're going to lose the shares at 60. So that's what happens. That's the only detriment to the covered call. This is a very low maintenance option strategy. There's not really much to do here. You don't have to monitor anything until expiration. If you decide to wait till expiration, of course, in this case, that's what you might want to do. Is short expiration date. It's only 11 days. It's a really good return on investment as long as it doesn't hit that price. And you can try to avoid any volatility by avoiding, like I said, any earnings announcements. So you might want to consider this trade in an area of consolidation where there's not much volatility in the stock itself. Okay, so this was a lesson explaining the covered call options trading strategy. I hope you found this lesson useful. If you have, please show your support for this channel by subscribing. Feel free to leave comments. Please like up this video, and thank you for tuning in.